On September 12, 1983, the lights in a West African finance ministry flickered as a clerk opened a brown folder. Inside was a ledger, thick as a brick, listing repayments due before sunrise. We think nations fall because of coups and wars, because generals shout louder than economists. They don't fall in battle, they fall on the balance sheet when insolvency turned sovereignty into a ghost. Outside, the capital still looked alive, with buses coughing smoke and vendors selling bread on cracked sidewalks. But inside that folder, the country was already bankrupt, even if no one said the word. The ink was cold, and so was the truth. That doesn't scream, it waits. You've been told the World Bank is a rescue ship, painted white, sailing toward poverty with medicine and engineers. You've been shown the photos of smiling children beside a new water pump and ministers shaking hands. The message is clean: borrow, build, repay, rise. But the ledger tells another story, and the ledger never lies. The World Bank is not a villain with a flag and an army. It's a system with contracts, deadlines, and clauses that bite harder than bullets. Its power is quiet, like a lock clicking on a door you didn't notice. You can't protest a spreadsheet in the streets, yet it can starve a nation faster than a siege. To understand the trap, you have to go back to July 1944, when the world's victors met at Bretton Woods. The war still smelled like ash, and the planners wanted order, predictability, control. They drew a mat made of money, not borders, and at the center sat an institution designed to lend, to rebuild, and to steer. In the early years, the loans went where the cameras pointed, toward Europe-wrecked factories and shattered rail lines. The West rebuilt itself with Western money and Western priorities. It worked because the borrowers had industry, markets, and strong states. Africa watched from the margins, still chained to colonial extraction. Then the flags changed across Africa in the 1950s and 1960s, with independence speeches and new anthems. The streets filled with parades, brass bands, and promises that tasted like sugar. The new governments inherited borders drawn by strangers and economies designed to export pain. They needed roads, power grids, schools, hospitals, and time. The World Bank arrived with a simple sentence that sounded like destiny: borrow now, grow fast, repay later. It felt modern, like concrete and steel replacing colonial dirt roads. Ministers signed papers with fountain pens and trembling hands. Behind them, history held its breath. At the surface, the deal looked fair, even generous, like a bridge offered to cross a river. But beneath the surface, the foundation was rotting. The loans were not just cash. They were instructions. The money came wearing a suit, and the suit came with rules. Picture the new capital at its peak. The illusion of majesty in full color. Imported cars glided past palm-lined boulevards, and government buildings gleamed with fresh paint. Delegations arrived with briefcases and polite smiles. Everyone talked about development like it was a sunrise. Gold watches flashed in conference rooms as men spoke in calm voices about progress. Maps were unrolled, dam sites circled, and 5-year plans stacked on polished tables. The country looked powerful on paper, with territory, minerals, and a young population. But the ledger was already counting what the speeches ignored, because the fatal flaw was addiction, and the first dose was cheap. Borrowing felt like breathing after being underwater for decades. The loans paid for projects, salaries, and imports that made cities look advanced overnight. And like any addiction, the body adapted, demanding more. Debt in this story is not a number. It's a living thing. It crawls into budgets and lays eggs in every ministry. It grows when commodity prices fall, when rains fail, when politics turn violent, and it never forgets a due date. The antagonist isn't a general with medals. It's a creditor with patience, a market that punishes weakness, a committee that approves Sometimes it's the bondholders in New York. Sometimes it's a consortium in Paris. Often it's an institution in Washington, speaking softly, holding the keys. By 1966, many new African states had taken their first major development loans. A highway here, a dam there, a fertilizer program promised to feed millions. The contracts included procurement rules that sounded technical, harmless. But tied money is money that returns home. A loan of $120 million might land in an African treasury for a week. Then it flowed back to a contractor in the lending country, paid in hard currency. The borrower kept the concrete, the paperwork, and the debt. The lender kept the profits, the influence, and the leverage. In 1973, the oil shock hit like a fist in the ribs. Fuel prices climbed, transport costs surged, and import bills swelled overnight. African economies that relied on imported machinery and refined petroleum began bleeding cash. The solution offered was more borrowing, and the addiction deepened. Then came 1979, and the second oil shock turned the pressure into panic. At the same time, global interest rates rose like floodwater. By 1981, semi-variable rate loans were effectively pricing near 16% or 18% for distressed borrowers. Let that number sink in, because a nation can't outgrow that kind of gravity. Export earnings were supposed to cover repayments, and export earnings depended on commodities: coffee, cocoa, copper, tea, cotton, and crude. But commodity prices don't care about school fees, hospitals, or elections. They move to rhythms set in distant trading floors. By 1982, the global debt crisis snapped shut like a steel trap. Banks grew nervous, credit lines tightened, and refinancing became a humiliating ritual. Countries that owed $3 billion, $5 billion, even $9 billion faced repayment schedules that ate the budget alive. The gold was gone. The credit was frozen. The Allies had turned away. That's when the help arrived with sharper edges. Structural adjustment was sold as medicine, but it felt like amputation. Devalued the currency, cuts public spending, removed subsidies, privatized state firms, open markets. The words were clean. The consequences were not. Imagine a currency devaluation of 50% in a single year. Overnight, imported medicine doubles in price. School books become luxury items, and spare parts for power plants vanish. People don't read IMF letters. They read empty shelves. Subsidy cuts were described as efficiency, but families experienced them as hunger. Bread prices jumped, transport fares climbed, and wages lagged behind. In 1984, a teacher's salary that once bought a month of staples might buy 2 weeks. The economy didn't adjust. It convulsed. Privatization came next, and it was described as modernization, but it often looked like a liquidation sale at midnight. A state telecom company valued at $400 million in public imagination might be sold for $60 million in a rushed deal. It was a theft. The argument was always the same. The state is bloated, markets are pure, and discipline creates growth. But the countries being disciplined were the same ones whose economies had been distorted by colonial extraction. You can't cut a patient open, remove organs, and call it fitness. You can only call it survival. By 1985, debt service in some states consumed 30% or 40% of export earnings. That's not a statistic, It's a siphon. Money that should pay nurses becomes interest payments. Money that should build water systems becomes a line item called arrears clearance. And when arrears appeared, the trap tightened. The solution was not forgiveness. It was another loan to pay the last loan. New money arrived, but only if the country signed new conditions. It was refinancing as ritual, a cycle that made poverty permanent. Think about the scale of that. A nation borrows to build, the project fails or underperforms. The nation borrows again to repay the first. The public loses services, sells assets, and still owes more than before. The human cost wasn't an accident. It was the predictable result of balance sheet logic. When you cut health budgets, clinics close. When you cut education budgets, classrooms overflow. When you devalue currency and remove food supports, malnutrition rises like smoke. In 1987, even mainstream observers could see the bruises. Reports circulated describing adjustment with a human face, a polite phrase for children paying the bill. But polite phrases don't refill hospitals. The ledger kept collecting, and the ledger demanded priority. The cruel genius of the system was that it turned policy into collateral. The loan wasn't secured by land or buildings. It was secured by the borrower's future decisions. The country pledged its tariffs, its subsidies, its state companies, its labor rules, its very options. In smoky meetings, economists spoke about liberalization as if it were sunlight. But for local factories, it was a flood. Cheap imports arrived, backed by foreign scale and finance. Domestic industries, still fragile, collapsed like wet cardboard. A textile mill that employed 6,000 workers might shut within 80 months. The workers didn't get retrained into competitive sectors. They became street vendors, motorbike drivers, ghosts in informal markets. The nation's productive muscle withered. Agriculture was pushed toward export crops because exports earn dollars. But export crops don't guarantee food. Farmers shifted from local staples to cocoa, coffee, or cotton to meet targets. Then global prices dipped, and the farmers fell into debt too. Now we reach the smoking gun, the moment where the trap becomes official. It isn't a dramatic battlefield scene. It's a document, stamped and signed, called a letter of intent or a policy framework paper. It reads like bureaucracy, but it functions like foreclosure. Picture a meeting in 1986. Fluorescent lights humming, coffee gone cold. On one side, a finance minister with tired eyes and political fear. On the other, advisors with calm voices and printed conditions. The minister says, "We need breathing room." The advisors reply, "Then sell the oxygen." They don't use those words, of course. They say, front-load reforms. They say, restore confidence. They say, unlock this. But the brutal translation is simple: surrender control or default in public. The agreement is presented as partnership, yet it reads like a liquidation sale. Tariffs must fall from 40% to 10% within 2 years. Public sector wages must be capped while prices float upward. State enterprises must be divested and foreign exchange controls dismantled. The country signs because hunger is louder than pride. Once signed, the nation's fate is scheduled like installments on a car you can't afford. Miss Atarit and the next lunch freezes. Miss Tu and the country becomes a warning example. Investors run, the currency drops, and the government returns begging for a waiver. The trap trains obedience. By the early 1990s, the continent carried debt like a backpack filled with stones. Some countries owed more than 100% of their annual export earnings. Others owed ratios that made repayment mathematically impossible. Yet the system pretended discipline could solve arithmetic. Default, when it came, was not a single day. It was a season of humiliation. It was payless months for civil servants. It was fuel shortages and rolling blackouts. It was mothers walking farther for water because the pump broke and parts were priced in dollars. The climax is always the same. The moment the money literally runs out, foreign reserves fall below a few weeks of imports, then below 2 weeks, then below 1. Banks ration cash, and queues curl around buildings like snakes. The government announces temporary measures, and everyone knows they are permanent. Hunger isn't poetic, it is chemical. It changes how people think, how they watch, how they obey. When bread disappears, politics becomes survival. When hospitals lack antibiotics, death becomes routine. And the lender, watching from afar, calls it necessary adjustment. Here is the phrase that explains the entire horror. Sovereignty is solvency. If you can't pay, you can't choose. Your budget becomes a document co-authored by creditors. Your parliament debates, but the real decisions sit in debt schedules. Even when growth returned in some places, it often returned in the wrong shape. GDP rose while wages stayed thin. Export volumes increased while local value added remained low. The economy became a pipeline, not a reservoir. Money flowed through, not into, everyday lives. And the debt didn't simply vanish when a dictatorship fell or an election arrived. Debt ignores flags and faces. It attaches to the state like a shadow. A new president inherits old obligations, and the people inherit the interest. Corruption made it worse. But corruption was not the whole story. Some loans funded projects that never worked, built with inflated contracts and foreign consultants. Some money vanished into offshore accounts, leaving behind only invoices and repayments. Yet the creditors still demanded payment from the public. This is where odious debt should have been a weapon, but it remained a word. The idea is simple. If a regime borrows without public consent and uses money against the public, the debt should not bind the people. But in international finance, morality is optional and collection is mandatory. Consider a composite tyrant, the kind history has seen too many times. He rules from 1970 to 1995, wearing sunglasses and receiving aid with a grin. He borrows $2.2 billion, builds palaces, funds security forces, and parks wealth abroad. When he falls, the nation keeps the chains and looses the thief. Now jump to 1996, when debt relief was repackaged as mercy. Programs appeared with names that sounded like salvation, promising to cut burdens for heavily indebted poor countries. But the relief still came with conditions, still demanded reforms, still insisted on the same ideology. It was a discount, not a pardon. Debt relief often worked like a reset button that didn't fix the machine. A country might see $1.4 billion canceled, only to borrow again within 5 years. Why? Because the structure of the economy hadn't changed. It still exported raw goods and imported finished goods, and the spread was deadly. By 2005, new initiatives expanded relief, and headlines declared the crisis ending. Some nations saw big portions wiped away, and budgets briefly breathed. Clinics reopened, school fees fell, and hope returned to the streets. But the global system had not changed its appetite. Then came the 2008 financial crash, a reminder that the rich world's mistakes become everyone's weather. Demand fell, commodity prices whiplashed, and capital fled to safety. African states that had been told to rely on markets discovered markets are fair only in fairy tales. The ledger tightened again. New lenders also entered the scene, offering alternatives with different strings. Infrastructure loans arrived packaged as speed and pragmatism. Roads and rail lines rose faster than before, and governments welcomed the shift. But debt is debt, and interest is still a blade. By 2014, one small African country in our story wrote what officials called the final check on an old adjustment-era loan. The amount was $38.7 million, paid after decades of rescheduling. The ceremony was quiet, almost ashamed. No parade for repayment, no monument to interest. Yet even that final check was not an ending, because by 2016, the same country had issued new bonds chasing dollars at 8% or 9% yields. By 2018, the currency weakened and servicing costs rose. The ghost of the old ledger returned in a newer suit. Then 2020 arrived, and COVID hit like a blackout across global trade. Tourism collapsed, remittances fell, and tax revenues dried up. Governments spent on emergency care while incomes vanished. Debt ratios surged, and reserves shrank, and once again the phone rang from the creditor's office. By 2021, several countries were labeled in distress or high risk. Those phrases sound clinical, but they translate into rationed futures. When debt service consumes the budget, development becomes theater. A nation can build a stadium but not maintain a clinic. The photos look good, the people suffer. The trap endures because it is not only financial, it is structural. Commodity dependence keeps revenues volatile. Currency weakness makes imports expensive and repayment brutal. Weak bargaining power makes contracts tilted. And every crisis becomes an excuse to borrow again under stricter terms. The World Bank's language evolves because language always evolves to survive. Structural adjustment became poverty reduction, reform support, development policy financing, new buzzwords. Same bag boni. Conditions still shaped budgets. Markets still dictated choices, and the ledger still demanded first position. You might ask, why would any government accept it again? Because the alternative is immediate collapse, and collapse has a body count. Leaders choose between a slow bleeding and a sudden death. Creditors understand this leverage and they price it in. That's not charity, that's power. And there is the colonial echo that never stops ringing. Colonialism extracted wealth directly through forced labor and rigged trade. Post-colonial debt extracts wealth indirectly through repayments and policy surrender. The chains change material from iron to paperwork, but they still bind. Look at the minerals, the farmland, the water, the youth, the energy. The continent is not poor in resources. It is poor in control over value. Raw materials leave cheap and return expensive. The difference is where the profit lives, and profits are political. Accounting decides destiny. When a country exports cocoa beans and imports chocolate, it exports work and imports wealth. When it exports crude and imports refined fuel, it exports opportunity and imports dependency. The ledger records the pattern year after year, and the pattern becomes a prison. The noir truth is this: development is not a morality play. It is a contest over who controls cash, pricing, and time. Credit buys influence, and influence shapes rules, and rules shape outcomes. The World Bank sits in that machinery, not outside it.